Hey guys, how's it going? This is Michael. I'm a head trader here at ARM Capital. We're doing our weekly market outlook and going over this bloodbath of a week that we just had across all the markets. So a little recap on how we did. Last week, we were actually negative last week. We had 3 losers and 1 winner, and it wasn't our best week. We're a little early on a couple of the trades. And it's even worse, being right about what's going to happen, but just having the timing a bit off. So we learned from that. This week was fantastic. We were 5 for 5, and we had 2 shorts on the SPY, one in the beginning of the week, one at the end, and same thing we had both of our QQQ shorts at the end of the week. And then we also took an Apple short, well, buying puts is what I'm referring to when I'm saying short. Because tech was just getting hammered this week, and we can look into that in a little bit. So overall, great week, great job, team. This is exactly what we like to see, especially going into Christmas. It's nice having a couple wins under your belt, especially going into the new year. We won't be trading Monday or Tuesday, even though the market is open on Monday. It's a half day, I believe, just because there's a lot of headline risk that's been coming out this weekend. About trade war talks again, and honestly, we don't want to deal with it. The volume is going to be really low, and that can make for some wild swings, but it's just way too risky for what we're trying to do here. So let's jump right in and look at how bad things did get this week. Dropping 6% on the Dow, 6% on SPY, 8% on QQQ, on NASDAQ. Insane. And we're definitely in bear market territory now. There's no doubt about that. We said that last week, and it was the right call, and it was a good one. So let's jump right into these charts. They all look really similar. The Dow is down 10% for the year. There's no support really that you can even see unless you zoom out to the weekly. So it's kind of just in free fall mode right now, and we will continue to be on the put side, the short side of the market, but it is getting pretty overextended. So we are watching for when it does finally find some support, because it'll either rebound a little bit from there. We try not to get burned on that, and after that we'll probably see some consolidation, which will make for some nice butterflies or some sideways positions that we can talk about later. SPY, this was our bread and butter this week. Just insane. Pretty much the same as the Dow, down 10%. QQQ, even though it's down 8% for the week, it's only down 5% year to date. It's holding in better than SPY and QQQ and then the Dow, but at the same time, it's also, I think, the highest value sector, and that repricing can come down a lot more, and I think we'll continue to see that happen and play out in 2019. Now the VIX. Now we've been talking about these levels for the last couple of weeks now, and we're finally starting to see something we can take a look at. We broke above 20, and we flipped to puts, and that's pretty much our one of our indicators that there's a lot of volatility in the market. There's a lot of uncertainty, and so uncertainty usually is a breeding ground for short markets. Now it happens that the VIX is up, and you can have a bullish market too, or some pullback, etc. But that's this indicator that we really, really like to use. So we're looking for basically what happened back in early February, January, February, when all the global implications of the Trump going into, I think it was Brexit. There was a bunch of political, pretty much rhetoric, and which caused a massive correction, and you saw all that uncertainty in the market come on fairly quickly too. Like here, you're seeing that 20 level that was broken, and it went up to 38 that same week day. They were on a daily chart that same day. That is absolutely insane. So it was very much driven by political headlines, and so what we're looking at right now is we're a firm break above 20. And so that means there's a sustained uncertainty in the market. Will you even drop below 20, 2 weeks later? So we've been above 20 now for about 2 months, and we've dipped below it, but the majority of this action has been above 20, which breeds a lot of uncertainty. So we do think we're in for more downside, as we've been saying. So we're looking for this capitulation to kind of mimic what happens here when you have like news come out or some event happen that really instills the fear in the market and wash out a lot of the traders and funds that are binded to their perspectives, or they need to get out if it goes below a certain rate. We need to have that happen before we can start stabilizing prices and then looking forward to a next bull market. So this is something we watch very aggressively. Sector recap. I mean, it's not too much to talk about. Everything was down. There was no one that was safe. The difference between last week and this week, you had utilities and tech were all right last week. They were about even, and that's what you're seeing people hide there. And I'm not sure why they're hiding in tech, as it's, in our opinion, still very, very overvalued. But utilities did make sense. But this week, what you saw was a break in a lot of those indexes price levels. And so you got capital flight out of the U.S. equity market into cash, into gold, and probably into emerging markets if I would put money on it. Smart money is recognizing that the U.S. economy is slowing. The hiking rates is instilling a lot of fear in the market because they need to basically what the interest rates do is they expand or contract the economy, right? So you either make it really accessible for people to get money to build businesses, and that's when your economy grows. But if you leave rates for too long, then you get people that are just addicted to this easy, money that you can get anywhere, and their companies are inefficient. They're burning money, and so if you go too long, like we have, and you're going to see a contraction, and it's a natural market cycle. They should have raised rates a long time ago. They're trying to do the right thing now, and Trump's trying to stop that, but at the same time, if you look at market cycles, it's almost a necessity at some point. Whether we'll get there in a year or 5 years, that's all up to the Fed. But we're definitely seeing the U.S. slow, and we would think that smart money would be pulling out of the U.S. equity markets and going into emerging markets that have been hammered the last couple of years while we were on such a bull run, because their valuations are very low and they have great prospect growth. So that's something we can look into a little bit later, although we're primarily U.S. markets. All right, last week's bullish sectors, utilities, and it was more like bullish because the chart looks great, but neutral because the whole market is shit. And so, I mean, no chart was safe this week. Utilities didn't even do well. We have zero confidence in a bullish outlook this week until the end of 2018. If you're bullish right now, you should probably find you probably shouldn't have money in the market because you're going to lose it all. So last week, our bearish sectors, we had energy, materials, and financials. We see a lot of the same this week. We're trying to identify the ones that haven't broke terribly down yet, but this week most of them have. So at this point, it's hard to justify a trade that's so overextended on the short side. So we're going to be sitting on our hands a little bit, kind of waiting for this to stabilize, just to keep some risk off the table. This week's bearish outlooks, we got financials still. I'm a big fan of showing financials right now. I think they have a lot more room to come down. I think that with the yield curve going inverse, that we're going to see that hit their bottom line when it comes to the first quarter, second quarter, when we start seeing the effects of that, them actually having to pay the loan to people, which is kind of a weird way to think about it. But so financials, I love the short side of that. Technology, obviously we think it's very overvalued. There's still a long way to go to fair value, and there's a lot of companies that just don't make money, and I've only been successful in a bull market and will not do well at all in a bear market. And that's about it. We're not going to offer any stock and alert selections until we might do a live video on Wednesday morning before market opens. because there's a lot of political headline risk right now. Over this weekend, you have a half day on Monday. You got Christmas on Tuesday. We're, as a fund, aren't taking any positions personally until Wednesday at the earliest, and that's going to be after we reevaluate, what happened with futures and what happened in between now and then. So I think that's it I got for you guys. Hope you guys enjoy your holidays. We look forward to seeing you in 2019. We got some great things coming, a lot more educational material, and a couple other things I'm not can't really reveal right now. But stay tuned and happy trading.